Hola mi gente, welcome back to the channel. My name is Sean. This is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, I'm going to show you what I believe to be probably the best options trading strategy for beginners, especially in these market conditions. I am going to do a deep dive on why I believe trading debit spreads far beats trading call options or put options in this environment. This is a easy strategy to learn. It's not complicated. However, you will need level 3 approval in order to trade spreads, but it's well worth it, as you will see in today's video. There will be cases where you enter into a spread and you will see 150% gains, while buying a call option or a put option might actually result in a loss. That is how drastic some of these spreads can be and how beneficial they can be for your portfolio. But in a nutshell, why are spreads so much better than just buying call options or put options? The reason being, and for this market in particular, with high implied volatility, is you won't experience an IV crush when trading spreads. Basically, what that means is because implied volatility is so high, the higher implied volatility is, the more expensive options are going to cost. If you see a decrease in implied volatility, well, you are going to see a decrease in premiums. Basically, Vega is going to decay your premiums, and therefore the position that you bought is going to be worth less. This is extremely important when you head into some catalysts like earnings or some other news events. You could see a huge decrease in implied volatility following that event. And even though the stock might move in the right direction, whether you're bearish or bullish, you can actually see your position decrease because of that implied volatility drop. Another reason why spreads are so good is because you will not experience theta decay. It's called a spread because you have a long leg and a short leg. You buy a put option, you sell a put option against it. You buy a call option, you sell a call option against it. You have two options working together and they offset each other. That way, you don't experience things like theta decay. Another reason why spreads are so good in this market and awesome for beginners is it lowers your cost of entry. Because you are buying a spread, you can get so much more for your money. Not only does it lower your cost of entry, it also puts you in a position where your break even is going to be less. Therefore, the probability of your trade actually being successful and being profitable will increase. Lower cost of entry, you don't experience theta decay, and you're not subject to an IV crush, makes trading spreads such a better product than buying calls or puts for beginners. Now, this channel does have a Patreon which gives you access to a private Discord server. It is on that Discord server where I post all of my trades. Whenever I trade a spread, and I do it often, I post on the private Discord server. Everybody is alerted. You can follow what I'm doing. In addition to that, other members of the community are also posting their trade ideas. It's a community where we learn together, grow together, and make money together. So if that interests you, for $5 a month, the link is down below. Okay, so we are going to go over two examples on today's video that will clearly show you why trading spreads is so much better than just buying puts or calls, especially in today's climate where we have high implied volatility and we have massive swings. So with that being said, let's dive right into it. The first example is going to be over a very popular stock, ticker symbol AMC. And as you can see by the chart right now, the stock has been going on a run. It is March 29th. We are using the on-demand function of Thinkorswim where we can go back in time and do some trades. So the stock has had a nice run. It is overbought on the RSI. It looks like it should come down. So let's hypothetically proceed with a bearish trade. Now, a trader who is new to options, a beginner, a noob in options trading, would say it's time to buy puts. Well, there's actually a better way to do it, and that is a put debit spread. But for the purpose of this video, I'm going to run the same trade just by doing a put option, and then I'm going to show you the benefits of the put debit spread. We'll enter into that trade and you'll see what your profit and losses are. Now, let's say that we want to enter into a bearish trade into AMC. We think the stock is going to go down, so we're going to enter into a put option. And let's say that we think the stock will bottom out at $20 a share. So if we go to the options chain, let's select the one that's 10 days away because AMC moves in a hurry rather quickly. So if we expand this and we need to go to puts, and then we need to find a put option to buy. Now, if we believe the stock can get down to $20 a share, we definitely cannot buy the $20 strike. That would be a huge mistake because we're paying anywhere from $75 to $85 to get into this contract. So our break even is already below $20. We need the stock at a minimum to be at $19.25. Depending on how much we pay will determine what our break even is. And we're not trying to get into a trade just to break even. We want to make money, especially when you're trading options because they are so volatile. And there's a good chance that buying a put option that is out of the money will expire worthless and could be 100% loss. So break even is not good enough. What somebody could do is they could end up buying the $22 strike, which is trading anywhere from $1.39 to $1.53. That would put our break even slightly above $20, still not good. But in this case, if AMC does get down to $20, you will make some money. So for the purpose of this video, we are going to proceed by buying a put option at the $22 strike. It's really easy to do in Thinkorswim. All you do is right click on it. You're going to hit buy. You're going to hit single. This is going to be a put option. And so now if I go to my positions, you can see that I have one put option for the $22 strike that expires on April 8th of 2022. Now keep in mind that the stock is at $28 at the time of purchase. What we are then going to do is we are going to hop into a date that is closer to expiration. So we are going to go to April 1st and see what the stock is doing. It is April 1st and the stock is trading at $23.68, which is far less than what it was trading at when we bought that put option. Stocks go down, you're buying a put option, you're bearish on the stock, your position should be positive. If we take a look at this position, it is not. It is down 7.19%. But how could that be? We bought a put option, it's a bearish trade, and the stock is moving down. Why are we not profitable on this position? Well, we bought a put option that is out of the money and short term. So we are dealing with a couple of things that are fighting against this trade. We have theta decay. We are also losing money to implied volatility. Those two things are outweighing the decline in the stock, and that is why we are currently down 7.19% on this position, even though the stock has gone from $28 to $23.68. Let's fast forward closer to expiration. Let's go to April 5th. All right, it is April 5th. The stock continues to go down. It is currently trading at $22.46. So it's continuing to fall. Let's take a look at our position. Our put is down even more. It is down 19.52%. Yet again, this is a bearish trade. The stock is moving down, which is bearish, but we are not making money. Let's fast forward to expiration, which is on April 8th, and take a look at the position. It is April 8th, and the stock really has fallen. At this point, we have to be making money. The stock is trading at $18.86. Let's take a look at our position. Yes, we are finally up on our position. It is up 119%. But for quite some time, we were negative on this position. It was not working out. And would you have cut losses? Would you have closed the trade? It was an emotional roller coaster to see our position down in value while the stock was trading down as well, which is something that I definitely do not like seeing. This is the experience you can imagine with trading put options when there's high implied volatility, which right now in this market, there's a good chance you're going to see high implied volatility because it's extremely volatile and options are trading at a premium. So with that being said, let's play this back, but instead of buying a put option, let's buy a put debit spread instead. All right, we're back to where we started. March 29th, 10:30 a.m. The stock is trading at $28.52. This is going to be the same trade. We are going to enter at the same time, and what we're going to do is we are going to pick a put debit spread that equals the same amount of cost. To get into that put option, we were at $155. So anywhere between $150 to $160 is the target for this put debit spread. The same concept is going to apply here. We are thinking that the stock can get down to $20. With a put debit spread, that should be the goal of the short leg because that's where you're going to maximize your gains. So if we can sell this $20 strike at $75, then to find our long leg, all we have to do is add $160 to that $75, and we're looking for an option that has a premium of around $2.35, which is this $24 strike or this $24.50 strike. So what we can actually do is we can enter a put debit spread, buying the $24 put and then selling the $20 put against it. So what we're going to do is exactly that. I'm going to delete this order. I'm going to right click on buy. I am going to then select vertical. I am going to buy the $24 put, and then I am going to sell the $20 put against it. And here's my debit, $1.51, which is the same amount of money we paid for that other put option. Going to hit confirm, and I'm going to hit send, and we got the order filled. Now, the first date that we went to was April 1st. So let's go to April 1st and see how our position is doing. Now, remember, in that prior example, we were negative. It's April 1st. The stock has dropped. It's trading at $23.70. Let's look at our monitor tab. We are up 23.51%. Remember, we were down with that put option. Let's go to April 5th. Here we are, it's April 5th. The stock is trading at $22.33. If we look at our position, we are now up 40.4%. Remember, with that other option, with just buying the put option, we were still negative at this time. Now, let's go to April 8th, right before expiration. Here we are, it's April 8th. The stock is trading at $18.97. It's really dropped. Let's go to the monitor tab and see what we're up. We're up 156.29%. So we are beating the gains with just those put options because remember, when we just bought that put option, we were nowhere near this profit. So the put debit spread is more profitable, and we've been profitable throughout. We have not had losses in this put debit spread in this example. The break even with just buying the $22 put at $150 was $20.50. The break even for this put debit spread is $22.50. So we have a higher break even, the same cost of entry, and we are profitable throughout the trade. Here we go. Now we're going to do another example, but instead of buying a put debit spread, we're going to go on the call side of things. And I'm going to show you the experience you can expect heading into earnings. The stock we're taking a look at is AMD, and hypothetically, we are bullish on this position. So I'm going to show you a call option versus a call debit spread on this position. So let's say we are bullish on AMD and we think it can get up to around $128 a share, $130 a share, let's say. We're going to go onto the trade tab, and we do have earnings coming up. So we're going to do the February 11th, 2022 expiration date, which is 10 trading days away. Earnings is just a couple days away. The stock is currently trading at $115.25. And what we are going to do is we are going to buy the $124 strike. That's going to give us a break even of around $126.50, which is slightly below what we think the stock can get to at $128, $130. So for the purpose of this example, we are going to proceed with purchasing the $124 call option on AMD. We'll right click, we'll hit buy, we'll hit single, and you can see that the price is $2.48, so around $2.50, which is going to be around $250. What I am then going to do is I'm going to proceed to February 3rd, which is a day after earnings, and see what the stock is doing and what our position did. Here we are, it's February 3rd. The stock is trading at $120. It has increased in value. Let's take a look at our call option. Good news, we're up 20.12%. That is awesome. That is an awesome trade thus far. Let's continue down this road. All right, if we head to expiration on February 11th, the stock is up since we bought it. It's at $125.36. But if we go to the monitor tab and take a look at our position, we're actually down on this call option. We're down negative 2.44%. So we're pretty much at break even. The stock is about to expire. This wasn't a good trade, but the stock still went up. So that is the danger with just buying call options, is a lot of things have to go right, and there is very high risk in just buying call options. Let's run back this trade with buying a call debit spread instead for the same amount of money and see what we can do. So we're back on February 1st around 9:30 a.m. Stocks trading at the same price as it was when we entered into that other call option, $115 about. We are going to go to the options chain. We are going to pick the same expiration. And keep in mind, we paid $250 around that price to get into that call option. We're going to keep that dollar amount the same for the call debit spread. What we can do is we can probably buy the 118 and sell the 126 call against it. Let's check it out. So we're going to buy the 118 and then we'll sell the 126. That's $2.36 in premium. We could probably do the 127. The 127 will cost us $250 to get into this trade. We're going to buy the $118 call and then sell the $127 call against it. We're going to hit confirm, we're going to hit send, and we have that position filled. Now let's go to February 3rd, which is the first date that I showed you on those call options. It's February 3rd, the stock is up, it's $120 per share, and our call debit spread is up 54.3%. Remember, the call option that we bought was only up 20%. Let's proceed by going to the expiration date, which is February 11th, and see what this position is worth. Here we are, it's February 11th. The stock is trading at $124. If we go to the monitor tab, you can see that this position is up a whopping 130.47%, where that call option was actually negative. Now keep in mind, we paid the same amount to get into this call debit spread that we paid to get into those call options. But why is this position so much better? There are a couple reasons why. It lowers your cost of entry, reducing the break even for your position. Also, you don't experience theta decay or any decay from a decrease in implied volatility. For this position, we bought the $118 call and we sold the $127 call against it. We paid $2.50 in premium. So our break even for this trade is if AMC is above $120.50 by expiration. Keep in mind what we had to buy with just buying a call option. We had to buy the $124 strike. We paid $2.50 in that case, and that makes our break even for that scenario $126.50 a share. And that is why at expiration, with the stock trading at $124, the call option is actually negative, while this position is up 122.66%. That is why buying spreads, debit spreads in particular, is the best strategy for beginners, in my personal opinion, in this market. Now that we're through the examples, I hope you can clearly see the benefits of trading spreads versus just buying call option or put options. It's super easy to do. A beginner can trade spreads, but like I said at the beginning of this video, you need level 3 approval. And just like anything else in life, you do need to practice, so it is going to be somewhat of a learning curve, but hopefully, as you can see from those examples that I provided, it is well worth it. This is an extremely tough market. And if you don't put in the work and you don't try to be a better trader or an investor by doing things like this and pushing your limits, then you are never going to be successful. So with that being said, that pretty much wraps it up for this video. Hit that subscribe button, ring that bell, and smash that like button if you like this video content. Let me know some other video topics that you might like to be discussed. And do not forget about that Patreon, which will give you access to the private Discord server where I post all of my trades and other members post as well. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.